Perfect. I'm going to let everybody in.
Bring them on. God, what is this?
Good morning, everybody. Thanks for hopping on the call. We're going to let everybody, it takes a second for everybody to get in.
Perfect.
Hope you guys are doing great. There's probably not a better time in the history of what we do in this market right now to know what we're going to talk about and where we're at in our business. So glad you guys could all show up, be on the call. We got some cool new stuff going on within Creative Dealmaker. We also have just some really, I don't know, just the market's just really, really, really good right now. So
it's just different, right? I mean,
Yeah.
it's a different market, and we'll talk about that too. So we've updated some stuff in the system. So if you are everything goes through the creativedealmaker.com domain now. So if you go to there, if you're an existing member, there's a member login. So will be where you'll log in. And if you're not a member and you want to join the Academy, you'll be able to do that there as well. So after we finish Office Hours Live call, this is the call that we do to our Facebook community and anybody else that wants to just listen in, the 5,000 or 6,000 people that we have. We get a lot of people that aren't available to do this now, right? So they'll go and do it later tonight or next week or whatever, and they'll come in and watch this replay and do it. So we're trying to simplify things, but what we're doing is, as we go into this, what we call our group coaching thing, we're talking a lot of things creative that aren't necessarily applicable to what we normally do in Office Hours Live. It's a lot more complex, a lot more details. We got a lot of people coming in from different communities. We do a lot of stuff, whether it be sub 2 or sub 3 or novation or hybrid deals. I mean, whatever. And we can't do it all in the Office Hours Live, because the problem with doing it in Office Hours Live, for most people, they haven't gone through the materials, right? We talk about this all the time. The reason why the materials are so important is to get what we call certified, right? And all certification means is that you've listened to what Eric and myself have put together so you can understand the next level of where we're going at, okay? Think about like math in school, right? When you go to school, the first thing you learn is how to do math, right? Basic arithmetic. Then you learn algebra 1, 2, and 3, 4. Eventually you get up to calculus or whatever else, pre-calculus. Guys, you can't get to the advanced math if you haven't learned the basic math first. That's the point of the Creative Dealmaker Academy in the class, so you can go learn it, because just because you think you know it, I'm telling you right now, most people do not. And it's not a knock on it, it's just because it's just different, okay? It's a different strategy, it's a different structure, because there's a lot of people that teach the creative side of it, but no one teaches the creative side of it on the acquisition and the exit with the note. And the note is the key to this model, not the acquisition, okay? It's the exit, not the acquisition. And so once you guys understand conceptually why that's important and why that's needed and what all that means relative to underwriting a buyer and stacking a collateral file and all the due diligence and stuff, you will understand why this is such a great model and a great opportunity where we are today. So, Eric, do you have anything else you want to add on that so we can jump into
I
the
was just
Office
putting
Hours Live portion?
I was just putting it in the chat. So just a few housekeeping items. Nick and I have updated our program. We have a whole new group coaching, which you just talked about that. We do that immediately after this call. These are for our paid members. We also, the course is being updated and with some of the new stuff that's going in detail with where the market is right now, with all the opportunities to get more creative with seller financing. Which I put in there, the creativedealmaker.com. And then also, if you guys have any questions, please put in the chat, because that's where we want to go over some of the items. And that's basically it right now. For we took a couple weeks off. Nick traveled the world, and that's what you get to do when you're a note investor. You're not stressing out about toilets, trash, and whatever else that happens when you own a real piece of property rather than being a note investor, a note creator. So
It's the first time so where was I last? I can't remember where I was the last time, but this is the first time I've literally done deals from, well, I've done several deals from 30,000 feet, relatively speaking, on airplanes. That isn't the first time I've done those deals, but I did that this time. But it is the first time I think I could be wrong. It was the first time I did one from literally the middle of the damn ocean. I could not see land anywhere that I was at. I was on a cruise and the internet connection was like having AOL dial-up. So I was a little
it
bit.
wasn't that bad because I spoke to you.
Yeah.
That's the greatest
Yeah.
part about technology and where we're at in the
It
world
was-
today is we can be anywhere in the world and do deals.
Well, the bottom line is we got it done. So bought and sold properties creatively.
Yeah.
You know, we'll go through the deal analysis. I closed on one of them yesterday. Closed actually Monday and one yesterday too. But these deals are everywhere. And what it's really important is that there's a shift, right? And although the base model, what we teach is the cash now, cash flow, cash later, which is a great model. We have to look outside the box, even though that's an outside of the box strategy. We got to go outside of the box. And what I mean by that is you have to be able to look at it and figure out, does this deal still make sense at a different level? And that's really why we released the CDM 2.0 and the group coaching, because I can't go in, I can't have conversations with the masses without knowing that they have some level of understanding. Because you know what, it's like giving somebody a gun, okay, but not being responsible enough to make them go through gun safety and gun training, right? I just give you the gun and you go do something stupid with it. But at least if I give you the gun, but I give you the instructions on how to use the gun and how to safely use the gun, right? I feel a lot more confident and comfortable with that situation. So we're part of the group coaching in the 2.0 is what I would call safe creative deal making, you know, because there is going to be some risk. We talk about no risk, infinite ROI, but now that pendulum shift a little bit and there's an opportunity, lots of opportunity to take on more deal structures that do have risk, but the upside gain is so great. You have to be able to go and evaluate it and be able to assess the risk. So that's the whole point of the other version of what it is. Current version still works. A lot of people still do it. It's a great model. I just did one yesterday where I did the same exact model and I took it down with hard money. And I was trying to negotiate with the hard money lender. I said, hey, can I just do transactional funding on it? I've already sold it. And he goes, no. I go, all right, well, whatever.
Do you want to be, that was when we were talking yesterday, I wanted to bring up an actual real deal that is the cash now, cash flow, cash later model that's actually working in today's market. We want to discuss that exact deal with the group and share with them what you did and how it worked out. I think that's super valuable.
Yeah, I mean, just at a high level. So everybody should have the model, right? So I'm not going to get into detail on the model on this call. If you don't have the model, you need to go download the model at cashflowdealmachine.com. Okay, it's a download. You got to download it. So don't ask for access to the file. You don't need to ask permission. You just need to make a copy of it. Okay. So once you make the copy of it, you can download it. And then there's a tutorial video for anybody that's new on here that shows you how to do it. So let me just show you a screen real quick. Let me just show you real quick. Yeah. I'm not going to go into the model. I just want to show once you download it.
There's new people on the call that might have come in from this month or
but
prior.
You know, as they come in new, they should have got an email.
Yeah,
they should have all this information in there. I just want to talk at a very high level here real quick. Give me 1 second to share the screen. Let's see here. I just want to show on here. So once you get this screen here, there's this tutorial video right here. Okay. Here's the tutorial video right here. This is the thing, tells you exactly what to do. You can see all my current stuff going on in this one account. And then down here, there's other things that you can do. Okay. But this is the main thing you have to do. If you've never done a deal, if you've not used the deal analyzer and you haven't done a model, you have to watch this video. Just click right here. It's a video, watch the video. It's extremely detailed. you should be able to have no issue going through it and walking through it, and then just download it. So if you go to cashflowdealmachine.com, I already have it downloaded. That's why I can't do it. So anyway, enough with that. So my point is, what I did is I put it in the model, and the model shared, told me it was a deal, and it wasn't a great deal cash wise. In fact, I think this one I just did, I already had the buyer, but I had it so fast. I think the cost, we talk about cash now, cash flow, cash later. This one, I took a little bit less down payment than the 10%, which I normally do. It needed a little bit of work. But the reason why I did it was because I could do it in like 2 days. So I took.
So tell me real quick, where did you find this property? How did you analyze it? How did you fund it? And then how did you exit out on this particular? And what were the general?
Well, I found it from a wholesaler.
Okay, so you're on a wholesaler's list. You're on a lot of wholesalers lists, and it's really interesting right now that
about 80 properties a day right now on my wholesale from my wholesaler.
We're hiring teams now to actually handle our inflow from the wholesalers that now can't sell properties, and we are the solution, and you guys will be the solution as you start understanding how you acquire and dispose of these properties and creating home ownership for people. So anyway,
exactly.
You found it from a wholesaler. How much was it?
I got it for $165,000.
Okay, and this is in Texas, right?
Dallas.
Yeah. Oh, in Dallas, which is before in Dallas, it was practically impossible to buy property.
Impossible. Well, yeah. Well, because it was impossible to get. 6 months ago, this was a $200,000 house.
Yeah.
As it stood.
Yes.
165,000. I sold it for 220, 222, I think, is what I think.
Okay. And how much you get down?
I got $20,000 down.
20,000 down, so they owe you 202, right?
Yeah.
And what's your interest rate on that for the end buyer?
9.95.
So now you're going from 9.5 to 9.95 because rates are going up, right?
Yep.
But also, here's the best part. That was a 250 to 260 exit before. Now it's 165 to 220. So we can charge more on our rate in order to make it still affordable for the consumer to buy the property. Did you do any rehab on this?
What's rehab?
Hey, there could be new people on the call that love to do rehabs, and we don't. So
I did not do rehab. I did not do any rehab. I don't think we clean. Preston asked, did I clean this one? I did not clean this one. I usually, if it's really bad, I will clean it because I'm not a fool from the standpoint of $500 in cleaning will get me $5,000 more in value.
Okay.
Even though it's against my
so now judgment. you get this deal. So here I'm gonna answer and ask you a question at the same time. So ask you the question. The best part about this deal is Nick has been infiltrated in that Dallas market. He already has the buyer's agent. So he uses a sales agent in that local market that already has the buyers lining up. They just need the property that you get so you can sell them a seller finance house. Is that correct?
Yeah. And that goes for anybody else too. So anybody
while
else
you're on a cruise ship, wherever in Spain or wherever the heck you were, this deal came through and you knew exactly at 165 in the pictures that was
it's
a
simple
deal.
Calculation, guys. There's a reason why I write the first lien at 75% or less.
Yeah.
Why do you think that is?
Yeah.
Because that's the break-even number also on doing the deal to get to the cash neutral.
Yep.
That's it.
Yeah.
So if you do it for lower than that, you're going to get a little more cash. I wrote it at 75. I would have wrote it if I was able to buy that at 72 cents on the dollar, all in, I would have made more cash. But it didn't make a difference because I still got a $30-something thousand note on the deal. It didn't make a difference. But that's why we use that number. So if you take 165, which is what I paid for it, and you divide that by 0.75, $220,000. I sold it for 222. That's the number. That's why I knew it was going to work.
And here's why Nick and I are really, really excited.
Oh, by the way, that's how come you can't lose, because if you use the model the way it's intended to be used and you put the data in correctly and you don't try to manipulate it, it will always win. Here's the best part about this model.
Why will it always win? Because you don't have any cost at that point.
That's correct? The break-even number.
There you go.
That gets you to cash neutral at worst. Now,
when you sell the first lien,
be cash negative, and we've talked about this before. Hey, would you invest $10,000 for a $40,000 second lien? Yeah, but you got to have $10,000 to do it, right? If you don't have the $10,000, doesn't matter how good of a deal it is, you can't do it. That's why I created the model, so people that don't have a lot of cash or access to cash can go create it. Okay. But here's the best part about this, guys. Whether you're directed seller or not, whether it's MLS or whatever, here's the advantage. Okay. My number has never changed. It's always 75%. It was 75% 3 years ago when people were buying stuff at 80 cents on the dollar, 85 cents on the dollar. And it's 75% now when people are buying stuff at 60 and 65 cents on the dollar. Okay. So let's think about this. So how hard was it for me to do deals? This is my 70. I'm trying to get my hands straight here. When I was buying deals, and this is my Mendoza line. Anybody know what the Mendoza line is? It's a baseball reference, but anyway, so this is my Mendoza line, 75% of value, less repairs at a certain, okay. So for the last 10 years, I've been fighting everybody and their brother that's been basically trying to beat me up because the sellers are taking higher offers. They're getting more than 75 cents on the dollar. What were hedge funds buying at? 80, 85? What were
90,
wholesalers negotiating at?
110.
80, 85? Well, if a wholesaler is negotiating it at 80 and I need to be at 75, I don't have a very good likelihood of getting that deal to work, right? Under the traditional model. But guess what's happened? They're not negotiating at 80 anymore. They're not even negotiating at 78. They're not at 75. Guess what they're negotiating at? 70, 65, 60, soon to be 55. My number doesn't change. So if a wholesaler is negotiating at 60 and I can make the deal work at 75, how many more deals can I do than a wholesaler can do direct to seller?
Yeah.
That's why now is the time to go direct to seller.
And $22,000 down payment.
Yeah. So now is the time to go direct to seller.
Yes.
Now is the time. It wasn't 6 months ago. Everybody's fighting in the same fight. Now, guess what wholesalers are? Guess who's not buying properties right now? Hedge funds, not like they used to.
They're slow.
If they are, they've shifted their model to a much more smaller.
And the model that they want is little to no repairs. And guess what our properties are? They're older homes. They need repairs, and our buyers can't wait to move in and do the rehabs. Although it's really cool now because we're actually able to actually get, when we talk about grandma houses, our grandma houses are getting a little bit nicer because we can still buy these properties and even do some hybrid models. But okay, let's go back to the math. So 20,000 down, 202 first, you create a first and second. And the cool part is, because it wasn't like now before you got to close in a couple of days because that's what all the hedge funds say they're going to do. You got more time. So you had this thing in escrow with on the acquisition, we call it the A to B transaction with the wholesaler. And then you had the disposition, which is the B to C to your end buyer. The end buyer is already in escrow. You technically could have closed that with their down payment money, sold the first, kept the second, and moved on without actually.
Well, here's the deal. If I wasn't in the middle of the deep blue ocean, I would have came in and I would have structured it a little bit differently.
Yeah.
I wouldn't use hard money.
No, but that's what we're at. That's what you and I are focusing on right
now.
now. Yeah, that's what we're focusing on right now with in our new program is how to do all these deals exactly the same way. Because guess what we have? We have the down payment from our buyer that's going to actually get us through these deals with no money out of our pocket, create amazing terms. We can even arbitrage.
Yeah, I call it sub 3, right? I mean, I call it sub 3, or I call it my Nick's novation note agreement. Same difference, fairly same. So most people heard of sub 2 before,
right?
But most people have not heard of a sub 3 or a novation. They've heard of novation, but we don't exit with a retail buyer. I exit with a owner finance buyer with a note when I take it down.
Yeah.
Suck on that for a little bit and tell me what it tastes like, because I know what it tastes like to me.
It smells like money.
Lips.
That's what does it smell like? It smells like money.
Did you ever see the movie Kicking and Screaming? Ever see the movie Kicking and Screaming? When Will Ferrell is when he's having the coffee for the very first time.
No, I don't remember.
Oh my God, it's so hilarious. because it tastes so good on my lips. Anyway, but that's okay. So guys, look, use them, use the tools, use the model, use whatever you want to use. But I'm just saying, and here's what I love about going in the future. You don't have to take any more risk on, guys. Eric and I can, if they fit the model, we'll still transactionalize them and get you out of all those deals. Every one of them. Pay you cash on them all the time. So what was the other question? So how did I fund it? Well, I funded it with hard money.
Hard
Cost
money.
me probably an extra $7,000, but
would you pay for your hard money?
12.9 and 2.
Okay. But you
You want
still
the
made money,
origination.
but that thing will be, you're in and out of that deal. And
Here's you want to hear something funny? I called for the payoff today to the lender. I just closed on it yesterday. And they go, I go, we haven't even closed on it yet. I go, yeah, we did. We closed it yesterday. I need my payoff. Like, whatever. It's just funny.
No, but this is what's going on in the market. We're able to actually get in and out of these deals quicker because we have time that we didn't used to have. But guess what we do have? We have buyers that are still coming out of the woodwork.
Buyers are everywhere.
Seller finance buyers are just going to get more and more plentiful. So that's why it's so important to know this stuff.
I think the biggest challenge,
if you know anybody that has a 30-year fixed mortgage, you and them need to know what we're talking about right now, because that's the biggest asset that they've ever signed up for in their lives. For sure. Sorry, I dropped my pen.
Anyway, and if you're having a problem finding buyers for your properties, then you probably didn't buy the right property, or you didn't negotiate a good enough deal, or something to that effect. Because if you have the right asset and the right thing, I mean, we sold 3 properties in the last 4 days.
Yeah.
Okay. There's buyers out there. Okay. There's buyers out there for all of it, but it's got to be at the right price, at the right deal. It can't just be some crazy over asking price and some crazy, whatever.
But Nick, I'm looking at a deal today where the seller, it's a $300,000 house. They want $5,000 down. They're going to lend us the money at $295,000, 2.5% interest, 30-year term with a 15-year balloon. It's $1,158 a month. I can sell that house all day long with no rehab right now for $330, and cash flow. The PI, the principal and interest payment will be right around $2,500 a month. So think about that's $1,200 in cash flow on just one deal. It's just that's a one deal, And guess what? My buyer's going to put 30 grand down, not 5. So I arbitraged everything across the board. I mean, and I'm paying pretty much close to retail on that deal. And the reason why is because the debt and the cash flow is so good. And I've got it past 10 years that it makes sense. But that's what we'll go into more detail on. And maybe that guy would only do 0% or 2.5% for the first 5 years. And maybe it goes to 6 or 7 after the next 5, and then 12% after the next 5. But we don't care after it goes to 10. It doesn't really matter what the rate is, because we just keep
just a calculation is all that it is.
Resetting the note, and our cash flow is so good, it doesn't matter because we keep cramming it down faster than our buyer does, Plus,
so let's go into the chat real quick. Let's see what questions we have in the chat. And then I'm trying to think if we want to, let's see.
So let's go.
Okay. So let's just go to the first one right here.
We'll go from the
bottom up. So Eric Young goes, most of my deals are in the high 400K range. Payment 10% down, rents are the same. I'm concerned with all of it, but I find buyers. Okay. So if you're concerned about finding buyers, why? I don't know. So let's bring Eric on. Eric Young, jump on, raise your hand so we can see you. I want to ask the questions.
Eric's in our group coaching.
Raise your hand so I can see you, and then we can spotlight him and bring him on. Eric.
I'm raising my hand on the video. Not sure.
There you go. I'm gonna spotlight you.
All right, good.
Go.
So
what's up, Eric?
All right.
Hey.
So let's just ask these questions. We know he's a professional because of the mic that he has. So he knows he must know what he's doing. So Eric, where are you located? Where do you physically live?
Denver, Colorado.
Denver, Colorado. Where are you trying to do these creative deals at?
All around C470, E470 loop.
So Denver, Colorado.
Aurora, yeah.
Okay. So why are you trying to do these deals in Denver, Colorado?
I have a brokerage in Colorado and I've
Okay.
got 3 renovation crews.
Okay.
And so I bring leads in and I give them to agents in my brokerage
Okay.
and they go out and close deals. We do a lot of fix and list deals where we renovate the person's house and then list and sell them.
Okay.
And my thought was some of them we buy and hold title to. Like I have 3 that were about to hit the market.
Okay.
And so I wanted to look into both using owner financing as a better exit strategy on the flips that I take title to. And then also as possibly a way to do more deals direct with sellers. So the sellers could
Right.
own a second at the end
Okay.
of their deal.
So I wish I had I don't have a whiteboard set up. So here's the challenge. Okay.
Oh.
The challenge is this. Not all properties fit all exits. Okay. Right. Some properties are better for wholesaling. Some are better for fix and flip. Some are better for buy and hold. Some are better for owner financing. Okay. So you got to be careful not to try to put a square peg in a round hole. Okay. So you got to understand what that exit looks like on the avatar, the buyer's avatar, right? What I personally like to do, I have multiple exits. So I look at and I draw, like if you draw 3 circles, okay, the first circle is maybe cash, buying it for cash, selling for cash, investor. And then you do another intersecting circle and you draw it, and that might be for fix and flip. And you draw a third circle, and that might be for owner finance. Okay.
Okay.
I'm looking for stuff that's in the middle where all 3 of those circles intersect. Make sense?
Yeah.
Then it tells me I can do any one of those strategies. But what happens where a lot of people make the mistake is they think they got a good deal. And well, let's look at it. 6 months ago, a house that you bought was probably a great burst strategy. Would you agree?
Yeah.
Okay. Is that same house a good burst strategy now?
No, it fell apart on you.
Yeah.
Just trying to get out of the deal. Yeah.
Right. So if that was your only strategy on the acquisition side, you sort of got a situation on your hands, right? On how you're going to cure it. Well, owner financing is not much different on the back side, but you got to know what that looks like. So if you have high dollar, it's like a pyramid, right? The higher you go up on a pyramid, the narrower it gets, the less people can stand at the top of it, right? So it's really, really important that when we deal owner financing, when we build that avatar out and we do deals, we need stuff that's where the masses fit, right? Where they can afford, where the affordability is there, where the buyers need seller financing, right? Now, I don't know, $400,000 might be the price point in that area. I don't know.
That's less than the median home price in Denver. I mean, it's cheap.
Yeah, but
It
doesn't
is.
mean
Yeah.
that's where people live that need a seller, that need owner financing. They may have to commute an hour from, Pueblo to Colorado Springs, for example, right? Or they might have to live, halfway to Fort Collins or wherever.
There's other parts of Colorado that have the math that does work, that
Yeah.
seller finance. But what I wrote in the chat was, and we can go through in more detail on our group coaching, but what I always say is if you have a deal, you can still create a first and still create a 75%, still create a 10% lien. But if you really like the deal and you have a decent down payment, you can lower your rate on your second lien if you want in order to make it affordable. The key is not to lower.
It's not going to make that much difference though. It's not going to change it because you're only writing a 15% second.
Right.
So even if doesn't matter if you go to 20% on the second or 2% on the second, the overall effective payment is not going to change very much.
Right.
So what the challenge with this is you get to a higher dollar value on the property. Okay. And you look at it, let's just look at the 88. Let's look at the 88% first lien sale price. Okay. We write a 75% and we get it and we sell it for 88. Okay. Let's call it 90 for illustration purposes. Well, if you have a $200,000 note and you can sell it at 90%, that's 100. What is that? 160,000, right? It's a $40,000 discount. Okay.
Right.
If you have a $400,000 note and you sell it at 90, that's a 60. See, I can't, I'm doing my head. Let's see, 90 of 400 is a $40,000 discount. What did I say the first time? 20,000. You see what I'm saying? The discount is the same percentage, but the dollar value goes up. Well, if you're looking at profit based on dollars, which most people are, it's a huge haircut that you have to take. So we don't want to get into that high thing because it's not linear, right? The value isn't linear, meaning people go, well, people most of the time say, well, I can make 50. Look, give me an idea on how much you look to make for on a fix and flip, for example. Just give me a ballpark.
It depends on how much money I have to tie up in the deal, but
Okay. Let's say the retail
typically-
price is $300,000.
I'd want to make around 25 on the bottom side,
There
and
there aren't houses for
40.
300,000 in Denver anymore.
Yeah, there it is. There's plenty of them out there.
it may be in Montbello.
Yeah, yeah.
25 to 40K.
Yeah.
25 to 40K. So if that house was twice as expensive, are you making twice that amount of money? Or is it linear, or is it not necessarily work that way?
It's not quite linear. So if it was twice the amount of money, then I'd probably be looking to make like 35 to 50.
Okay. Which is very similar. Let's talk about why this doesn't work at the higher price points. Okay. Hey, Elvia, can you do me a favor? I think, Eric, let's just stay in here for this one call. Can you get Sarah to come on, and what we'll do is we'll just bring Sarah on here to go through the backing, because I want to sort of preview that to the people that aren't in the academy anyway, Eric, and just give them a little preview on it. So can you get Sarah on, Elvia? Have her join in here, tell her to raise her hand, and then once we're done with Eric here, we'll jump on over. So what happens is this is why higher price point properties are difficult, because one of the things that makes owner financing work, and it doesn't have to be dollar for dollar, it's ownership value versus rent value. Okay. If I can rent it for $1,500 and I can own it for $1,500, the decision that the buyer making is much more objective. Okay.
Mm-hmm.
However, if I can rent it for $1,500 and own it for $2,000, people are really payment driven a lot of times. It changes things. So for argument's sake, let's go back to what you were talking about on your $400,000 house. What is the rent value on that house?
About 3,500.
Okay, so that's actually pretty good. It's a lot more than I thought it was going to be. Property taxes are low, relatively low in Colorado. So the $3,500. Okay. So now if you go to and do that on owner finance for the $400,000, you get the down payment. You're probably not going to be that far off on it. Let's just see here. Let me just run the math.
Yeah.
Let's see what that comes out to be. We go up here and we pull up a calculator real quick, and let's just show it real quick. I'm going to share my screen. Go back and share this. Find it. So let's look at this here. Can you guys see my screen? Okay. So let's just say it's a $400,000 house and we get 10% down. That's 40 grand, right? So $360,000, let's go to use the same math, because we can't discount interest rate. That's the other problem. Even $1 million house, we still got to write the same interest rate, because when the note buyers look at this, they're looking at yield and they're looking at investment to value. So could we write it for less? Yeah, but you run the risk of having to take a bigger discount. So let's just run the payment on this. It's $3,027, even at 9.5% on 360. So this is actually, your situation may actually work here. That's why we're going through this exercise, right? So what's property tax on a $400,000 house in Arapahoe County, wherever this is?
Yep. So I guess the $3,500 rent was more like a $470,000 house.
Okay, well, let's change it to, let's just change this here. Let's do 470. We get 10% down. Let's call it 50 down. So let's do 420. Okay.
Yeah.
Now the payment's going to go up to 3531. Okay. That's before taxes and insurance. It's just principal and interest only. What's property tax on a $500,000 house in Arapahoe annually?
About $2,500 a year.
Okay. Another 200 a month for insurance, or is it more than that?
Insurance would be somewhere around $200 is
All right, call it
close.
200 for
It's
insurance.
probably $4,000 for the whole thing.
200 for insurance, and about 300 for that, right? So that puts it right at $4,000. So the question becomes, do I want to own a $470,000 house for $4,000 a month? Or do I want to rent a $470,000 house for $3,500 a month? Right?
Right.
At those ratios, at that type of buyer, you only need one to say yes, right? So you're
Right.
okay with that. But what happens in some markets and some price points, the variance gets a lot bigger, right? Hey, I can rent it for $1,500, but I can own it for $3,000. Not a great deal, right?
Right.
Not as good a deal. So we were trying to take the subjectivity out of the equation. Now, as rents continue to go up, we're able to see that a little bit more. But my point is, if you don't have to fix them, okay, if you don't have to fix them, do they need to be in your backyard? Because obviously, would you do a fix and flip? If you live in Denver, Colorado, and you had a house in Houston, would you fix and flip a house in Houston, Texas, living in Denver, Colorado?
No.
Probably not, right?
Big profit to make that make sense.
You have to be huge, risk,
Mhm.
liability, all that kind of crap. However, if you had a grandma's house or a house that somebody just moved out, it was clean, you didn't have to do anything to it except market it. Would you do that?
Yeah. Yeah.
Why wouldn't you? Right? I mean, if you can control it and control it, not own it, and control and figure out how to do it, yeah, you'd be much more likely to do that. The next question is, how many houses can you do in Houston, Texas that you don't have to fix and flip versus how many that you can do in Denver, Colorado that you're doing a bunch of work on? Right?
Right.
So,
But I mean, the other side of it is you have a brokerage, right? So how many agents are working your brokerage?
I've got 7, but 4 that are active.
Okay, so but you got 4 active people out there that are going to have people that need homes that aren't able to get bank financing, that are going to have big down payments, a lot more than you think. And so when the market crashed back in 2008, back then, I'm a perfect example. I had 70 some houses. I had the market crashed at $20 million worth of real estate that went to that went to $5 million worth of real estate, but I had a bunch of debt on it. And so I still went out and found a house on seller financing and put $200,000 down on a $600,000 house. So there's more in that market where you are. There are people that are going to have the down payment. You just have to put it out there, number one. But there's also different markets around the country where you can buy houses for $75,000 and sell them for $150 on terms with $30,000 down. I mean, we have
if you don't tell somebody you're offer seller financing, you'll never get a buyer.
Yeah,
seller financing.
Right.
That's right. Well,
Right.
But Eric, when we originally spoke and you joined the program, I mean, you have flip houses that, I said, okay, you could still offer seller. I have a bunch of people right now. I mean, we have a client right now that they have all this inventory.
That's me.
And I go, you guys need to at least, you have hard money and gap money that you're paying interest on. And it's starting to calculate into a problem. I said, go and put those houses on the market on terms, because they're really, really nice homes, and start backing into where the math works, or just punt, get rid of them, because they got hard money building. So that's what's happening right now.
That's a great point. That's a great point. Again, this is where I think a lot of people really have a difficult time. We just came through a huge shift, right? The wind changed directions literally overnight, right?
Mm-hmm.
And we're sailing down one way, and then all of a sudden it shifts the back way, and we got a problem now because we weren't planning on going the other direction, at least not right now. So we have inventory, or we have stuff under contract or under construction that no longer really fits that model. So what happens is a lot of times people go, well, hell, I don't know what to do, because I'm going to lose $10,000 on the transaction. Well, the bottom line is this: it isn't your only transaction, right? You want to get that capital back and freed up so you can go redo it again. And because look, are you going to stop with this inventory that you have right now? Once you sell it, are you done in real estate forever and ever, and you're not going to do any more deals?
Oh, hell no. In fact, that's why I'm looking at some deals where I was projecting to make 50, 60K, and now I'll be lucky to come out with like 10. Another one.
Hey, even if you had to scratch a check for 10, it still makes sense to do it more than likely, because the opportunity.
But then you get the 50, 60 grand on the back end that you'll get paid over time.
Yeah, you guys start. You
Well,
start,
that's where I'm looking at. Maybe I do owner fin. Maybe I walk it. I sink 60 into the deal, right? Like I don't even get out even, but I have a huge note in second position, and
100%.
I learned, and I can do it moving forward. But I'm trying to get a handle for what kind of haircut do I have to take on selling the first in Colorado? If it's like a 10% note, is it is
oh,
90%?
you gotta write it, you gotta write the 2 notes, because the problem is that
Yeah.
you're going to get into is that it
Yeah,
has
I
to
mean-
be relative to value, right? And a note buyer, I'm a note buyer, that's what we do. That's
Yeah.
primarily what I do. I'm teaching all this because I know what it takes to buy a note or to sell a note. And I already know that that's what we know. So what the 2 main things that a note investor is looking for, okay, there's 2 things. They're looking at yield, which is their return on their investment, obviously, and risk. Okay, like any investor is doing the same thing. You go buy stocks, you go buy crypto. It's always the return versus risk. Okay, so when we write that first lien at a 75% or lower, the investment to value is less, right? For example,
Right.
a $200,000 note. If I wrote 1 note and I try to sell it for $180,000, the discount is going to be more because the risk, there's a lot more chance I lose some of my
Yeah.
capital as a result. But if I sell the same, if I use the same asset as collateral and I write $140,000 first and I sell that, okay, it's still secured against the same $200,000 house, right? Which
Right.
one is more risky? Investing 140 against 200,000 or 180 against 200,000?
Yeah, the one
Of
180
course
is
it
way
is.
more
So then I'm
risk.
gonna ask the next question. Okay, people go, well, how important is, the quality of the borrower? Well, it's important, but let me ask you a question. If you're gonna invest, and this goes for anybody, because people invest in stocks and bonds and whatever, would you rather have, because here's the golden handcuffs on all of this. The property is the collateral and it protects our investment, not the quality of the borrower. I mean, the borrower quality is important, but it's not nearly as important as a Chase or Wells Fargo or Bank of America would make you want to believe. Okay, because they
Mhm.
decline borrowers all the time, right? So my question to you is, do you want to pay $180,000? Let's say everything's at face value. Do you want to pay $180,000 for a note that has a 10% yield on it, and the borrower has a 750 credit score and works for Frito-Lay? Or do you want to pay $140,000 for the note that has a 10% yield against the same $200,000 value, and the borrower has a 520 credit score and has a landscaping business? Which note do you want to buy?
I want to buy the second one, but I have a higher risk tolerance than maybe the average person.
No, but you don't have higher,
Yeah.
but there isn't higher risk. It's lower risk
Yeah. on
because
the
you have
second-
the property as collateral. If the buyer
Gotcha.
defaults, guess what happens? The
6
buyer
months of
defaults.
foreclosure, probably.
Well,
Yeah.
whatever.
Yeah.
You still have the lien in the first position against a $200,000 property. I much rather only be into it for 140 than 180.
Right.
That's what a sophisticated note buyer is looking at. They don't care. It's like asset-based lending, in a way, right? It's what it sort of is. So we wanted to pass the asset test first. The borrower is a portion of it. A bank makes the borrower much more, it makes them much more skewed. They're looking at the borrower first, not the asset, because it's all insured, Freddie and Fannie, all that bullshit. That doesn't really apply to us, right? So at the end of the day, that's the bottom line. So we just make it simple. So I write the first, and we'll take the risk being in the second lien position. Okay, we'll underwrite the buyer. If that's our profit and the buyer defaults on the first, for example, well, the first lien holder is going to get paid in full a lot easier than the second, but there's no cost basis in it. So what's our risk and exposure? So anyway, I want to bring, we can come back here in a second, but I want to get Sarah on because she only has a few minutes. And so, Eric, we can circle back. Did that answer your questions on that?
Yeah, I have other questions, but I can wait.
All right, why don't we do this? Why don't we go, let me get to Sarah and then we'll open up and do some general Q&A inside the group and we'll raise our hands and we'll call them back in and we'll stay on for what we need to do. Because what we're gonna do, Eric, I think we'll just bring this, instead of going to the group coaching for the members, we'll leave it open for this group. And then we will just be a little bit more selective on what we share and what we do. But I
Yeah.
want to give them sort of like a little bit of a preview on some of the stuff that we're going to talk about, plus also see it in there. So Eric, we'll bring you back on here in a little bit, but let's get Sarah on right now. Sarah, where are you? Can't see you. Raise your hand.
I'm right here.
Well, you say that, but I don't see
Oh,
you.
hi.
Hello,
I do. I
there's
see you.
Sarah. Hello, Miss Sarah. How are you?
Good, good. Hello, everybody. I just want to say hello to the Creative Dealmaker community. So Nick and Eric have had some really exciting things coming up, and we've been working on the Creative Dealmaker Academy 2.0. So this is the upgraded version, and one of the big things we've done with the upgraded version of Creative Dealmaker Academy is we've been able to move the content onto a platform that will allow us to have a community that is not only on Facebook, but then for our paid members, be able to have a private community within our own app and everything. So for those of you who have previously purchased the Creative Dealmaker Academy, you have actually been grandfathered in, and Nick and Eric have moved that all over so that you're getting a wonderful, I mean, it pays to be first. And I think
Hey,
Ricky
Ricky Bobby
Bobby,
said, if you're not first, you're last.
yep. And so definitely those of you who have paid for the academy in the past, please make sure you check your emails. If you haven't already seen the email to come into Mighty Networks and into our our Creative Dealmaker Academy and community, then please make sure you go in there and take a look in your email. Now,
They should have
for
also got
the
an email. They should have also got a text message and probably a phone call or voicemail as well. So guys, if you've already joined the academy, check your emails and do all that stuff so that you can, because Shara's going to show her screen right now. Can you go log out and actually come in from the, like, go to the web, go in from the website. I'm going to give you screen share. So go to creativedealmaker.com and then you can see where the member access is. And then let's go in there and spend 10 minutes just showing them around, because
You
what's
bet.
important about this piece is that we're not going to be held hostage from Facebook on our ability to communicate, right? I mean, that's a huge thing, is that we want to be able to communicate and with you guys in a private forum that that's really specific to what we're
That we
talking.
actually can control. And when we send you a message, we know you see it. That's the most important part about this.
So
Yeah.
there's two things up here, and Sarah. So if you're in the academy, go to the member login. If you want to join the academy, click on join the academy. So if you click on join the, just click it real quick since you're there right now. If you're not in it, go here, go to creativedealmaker.com, hit join the academy, watch the video, join now, whatever it is, and go. So go ahead and we're not going to go through that right now. They can do that on their own. So let's go back to the member login. Let's go into the site. So don't log in as support though. Can you log in as you? Yeah,
I will.
because it's a different user interface.
It is.
Sarah always has the best you with your headset. I need to get a headset. I like how you're
She reminds me of the Time Life operator though. I'm a little
It's
disturbed.
true. I look like I'm either ready to game all of the time or that I mean, luckily I have a cool backdrop. And so nobody thinks I'm in a call center or held hostage somewhere, but
That's a real backdrop. That's not a fake one.
It
'Cause
is. It
we've been in
is.
that office. We like the office.
Yeah.
Anyway, all right.
All right. So when you come into the Creative Dealmaker Academy, you're actually going to first of all be prompted to log in. That's your very first thing that you need to do. You always need to create a username and password. That's going to come up immediately for you, and it does take about 5 minutes from the time you join to really getting that username and password to recognize that you are a paid member now.
Now,
So
when we put everybody in with the email they used when they bought it in the beginning, okay?
yes,
So if you change your email or you forgot what that email is, then you're gonna need to reach out to us so we can get it reset. You need to send
it
it
would
to.
have also been the email we sent the invite from,
But what I'm
or
saying is,
to.
but what I'm saying is this. If we send it to an email that maybe is an older date, not using any longer, they wouldn't even have got that. So
Yes.
if you signed up and you paid for it and you haven't got any communication, then just send an email to support@creativedealmaker.com. LV or somebody on the team will go research it and see what it is, and we'll make sure we get you access to the platform.
Yep. And then within here, you're going to, like I said, see our most recent posts and updates. It's going to prompt you what is being seen in here. And then you can come into the course itself. This is going to look ever so slightly different than yours will, only because I have editing capability within here. As a member, you will not have editing capability in here. So that's the only reason it looks slightly different, or you see the adolescent. Yours will not say adolescent. It will simply be, you click into the welcome and you're going to see that. This still has all of the content that we have had in Creative Dealmaker Academy, but this is where we're going to be updating additional content for you. There is an activity feed within here as well. So you can also come here to post additional questions, possibly even questions that you have about the course itself, and about the content that you find in here. If there's something specific, please reference it inside of the course activity feed. If this is generally like, hey, I'm new to the community, I would like to introduce myself, that is generally going to be best done in here in the home field. We're also going to have, as this rolls out more and we get more of our office hours lives, the previous and the current ones that are coming out, we're going to be updating all of this and tagging it with various topics. That will allow you to be able to come in and select the topics tag, and you can actually choose from a selection of topics that are in there. It also has a searching function where you can search out a specific topic, and you will be able to see all of the posts or questions from other members revolved around that topic.
It's like the Google function of what we do. So if it's
Right.
seller financing, wrap, sub 3, whatever, whatever we talk about, we're going to really do our best to note it so it can be searchable. So on your own time, which, by the way, the phone app is amazing. I was on it yesterday, and it's
Download the app. There's an app.
Download.
Yes.
It will have in the emails as well. All you have to do is save the function. I'll make sure, triple sure that you guys have the mobile function instructions in there. But that is a really neat feature of it, as well, as that you get a very cool app, and we're able to go live from our phones now. We're going to be able to go live in Zoom and everything within this. We'll be able to have you post video and various questions that you have directly from your phone into the app. Additionally, you'll be notified when there's new content in the app for you to go and take a look at. And then you also have the function in here. There's going to be notifications. You can also chat amongst yourselves. So with the chat feature up here, you're able to talk to other members and create new synergies, new opportunities, and be able to work together on additional deals and be able to bring those with Nick and Eric. This also gives you the function to be able to have private conversations as well. Understanding, of course, Nick and Eric are going to be active in the app, but understanding that that may take them a day or two to be able to respond to everybody. So, but it does give you that option to ask questions in here, and they're always best asked here in the main feed, of course. That way everybody can answer. Everybody can be a part of it. So,
Yeah,
but
that's one of the
it's great.
things, one of the things in Facebook is there's questions. So what we do is we go through and scrape all the Q&A from the week before when we go on office hours live, which we'll still keep doing, but we want it to be, if you're in our group, then we're going to have it here, and then we'll be able to actually answer and go deeper into this stuff as the market changes with seller financing. I mean, it's going to be pretty exciting on what we're doing and how
Yeah,
we're
and
sharing all
and I
the deal
just
flow that you can model, you know?
Well, and just to distinguish the difference between office hours live and the group coaching is the office hours live is really more geared toward the people that are, even though that's what we're on right now, a lot of
Yep.
stuff that we would already shifted over to is actually deal structuring and the actual, getting stuff done. But whereas office hours live is really going to be more suited for somebody that isn't already in the academy, wants to learn a little bit more about it and just sort of see what we're all about. But as moving forward, if you're already in the academy, you don't really need to join after today the office hours live portion unless you want to, because we're really going to get into the nuts and bolts of it inside of here right here when we talk. But
We
there's always going
normally
to be
go
something of
from
value.
but we normally go office hours live right into our group
We
coaching
will.
back.
We're just
Yeah.
combining the two today because of I just wanted to, after thinking through this, I go, there's a lot of people that might need to see what we've been talking about visually and the benefit, and then ask any questions relative to the community, how it works. So what I like about this also, like, go over to the events real quick. So this is where we put all this stuff in here. This is the calendar. Now, will this automatically populate to their calendar as a reminder as well, Sarah?
They can, if you come in here, you can actually, I believe you can, save the event. You can add it to your calendar, everything. All you have to do is just come in here and, hit one of these buttons. However, let's say you're going to be on vacation and hey, I don't really want to be notified about this group coaching because I'll be on vacation. Great. You can actually just mute that event versus muting everything within there. And so it does make it very nice to be able to say, plan out your week so that you have the time for group coaching, so that you're taking the time to nurture those deals and really, get your business functioning in the way that you want it to. And then the other great part about this is, like, it will let you know if a group coaching call is live right now.
Great.
And then it does a countdown on these ones. Hey, here's when this one will be beginning, and all you have to do is click into this. I'm not going to do it because otherwise it's going to cause all kinds of funky things, but you can just join live right from here as well.
And
So
yeah, this is great. So go up to the members real quick. Does it show the member directory of who? Now, everybody hasn't even come in here yet. So everybody's going to show up as a new member because we just moved this over, even though you guys aren't technically new members. And then, you can click on that. You can find out information. Like,
you'd be able to come in here and see their, sorry, Ryan. I hope this is okay. But anyway, you can see their profile, who, and again, follow, chat. So much like Facebook, you can actually have all of these functions in here to be able to work with those deal makers who are where there's a good synergy and
Yeah,
opportunity.
remember, guys, this is a private community. This is your community, right? We built this for you guys. So you invested time and money to be in here. That's what it's for. Okay. That's
But
why
Nick
it's
and I, but
separate.
Nick and I have invested a lot of time and money too, that we're gonna bring in even more stuff that's coming in along the way. It's just gonna
But
be,
just
it's really gonna
understand is
grow.
that this is not a freebie deal, right? So you got to pay to play, and you got, if you want to play and you want to play at a high level, this is where you want to be ultimately. So, we'll still offer stuff up of value through YouTube and Office Hours Live and inside the Facebook community. But really, to get stuff done and actually really monetize and do the deals, this is where you want to be, because we all going to work collectively in this community to make things happen. Oh, did I go? There I go. So I want you guys to understand that. So if we want that to be the attitude of the community, right? So knowing that if somebody, it's one thing to post something in Facebook and have somebody respond or not respond. There's no accountability there because it didn't cost them anything to be in that group. However, when it's in here, if somebody reaches out to you, at least respond back with something. So because they paid to be there just like you did, and we want to sort of reciprocate that back, because we'll be stronger together as a group than we ever will be individually. All right.
Yeah, real quick, Gerard, I'll let you, Gerard asked if we're gonna be doing live events, and the answer is yeah, we will do some. We've got
Yes.
stuff, we have a lot of stuff in the hopper of what Nick and I are doing.
100%.
That we've done business with and bring our communities together, because the live events are coming back and we enjoy them. We're going to one this week, so it'll be good.
Yeah. So real quick, while I have Sarah here, and relative to the platform only, does anybody have any specific questions that we can get answered? So I can let Sarah go back to doing whatever what she was doing with her headset.
Playing my games.
Yeah.
Go back to playing Call of Duty.
Yeah.
All right. So I think that's fine.
And we'll send out the replay. So if you miss something or
Yeah.
we'll put it out there. So that's cool.
All right, cool. Anything
Sarah.
else, Sarah, you want to add, or does that pretty much take care of it?
No, the only other thing that I was gonna show within that functionality, and it's not super pertinent, but you can also comment on other people. So if somebody has a question and Nick and Eric maybe haven't posted, you can even post additional either additional questions to that, but it is just like the Facebook feed forum. You are able to make comments, you are able to add pictures, you're able to add emojis and all of that stuff. So it's going to
Without a
be
bunch of
really
spam.
great.
Without a bunch of spam, right? Because
Yeah, without all the or any of the garbage we all experience on Facebook.
that's just that's just unfortunate part of having access. All right, Sarah, thanks for that. And guys, if you're supposed to be in and you haven't got an invite, make sure you check your spam, reach out to support if you need to, because I know there's probably 75 or 80 of you guys that have not gone and done what you're supposed to do yet. So we're trying to get everybody informed. Not everybody's active like others, but we want to make sure the ones that want to be part of it and want to benefit from them at least have the information they need to get started. So, all right.
Yo, Preston, I heard you're having issues with your printer.
Yes.
Do you want me to help troubleshoot?
Uh-oh.
This is now a good time.
Wait, let's see.
Got it.
Preston, Preston, what was that about the printer? Oh, you just muted us.
Yeah.
Preston, we need to know.
Yeah.
Is it a dot matrix printer? Laser? Inkjet? Just kidding. All right. All
Thanks,
right, thanks,
Sarah.
Sarah.
You're awesome. Thanks for all your help.
All right. So hopefully that was
Thank you.
helpful. So guys,
All right.
again, if you want to join the academy, just go to creativedealmaker.com and join the academy. If you're already in it, you know how to log in, because this call moving forward, that the non-office hours live call will actually be hosted in there. That's where all the replays for that'll be moving forward. All right, so let's get into let's go let's finish up with Eric real quick. And then I want to get into our general Q&A, and then if there's anything else that we need to address, we'll do that, and then we'll wrap the call up. So
All right. I'll
Um,
swallow it.
let's go back to
There you
Eric.
go. You're back.
All right.
That was our commercial.
If I follow everything you guys are saying and I set up a first and second, the first is 75% and say it's a 10% interest rate. In Colorado, about what would the haircut be on the first?
Well, it's the model, right? If you, the model is the default, right? 95% of the deals that you do in the model, that will be the answer. Okay.
He's asking, is it 88%? Is it
Well, what
90%?
does the model say?
Well, the spreadsheet says 96%, so 4% is the default.
No, it
in
doesn't.
this.
Yeah, no, it shouldn't
Okay.
be. It should be
No.
no more. It should be no less than
Unless somebody
90.
changed the formula, it's not. I mean, let's just go look at it and see what it is.
Yeah.
Shouldn't be. Let's see here.
Mm.
Let's pull this up. Master.
Yeah. So one said it's
Sometimes
88%.
things get, what's that?
It should be 88 to 90%.
Yeah, I'm looking at it right here. Let me show the screen.
Yeah.
Give me a second. So this is why, guys, this is why it's super important to follow the instructions, okay? Because if you look at this right here, this is the master, okay? This is the
Yeah,
master.
I don't have this. Where could
And
I
you-
get this?
It'll cost you another $100. No, cash flow deal machine. Somebody put it in the chat, cashflowdealmachine.com. Make sure
Yeah.
it's got the, if you guys haven't downloaded this in a while, download a new one, because you should be on release 4.0 with this date right here. Things change, right? The environment changes, the market changes. So if you look at this sheet right here, it defaults at 72 and 88%. Okay. You model this at 72 and 88%, you'll never have a problem. And you can see some of the changes are right here since the last version. But when you put it in here, this is the model right here. So watch this video, click on this video, pretty good video, and just click on it and see what it looks like. All right, it's right here. It's the actual video for the actual model.
To see everyone.
Okay, here it is. I go through each of these, go through each of those line items, okay? So that's it, okay? So download, make it go in the master. Once you download it, first thing you want to do is go and duplicate the master. Don't touch the numbers in the master. Make a copy of the master, okay? Just go in and rename it. I'm just going to call this test, okay? You know, test is a thing. And now you're in here. That way you don't, if you because these numbers can be manipulated, right? You might find out that you want to charge 9.95%, okay? Change it here, 9.95. All right. You may get, you know, it says minimum 8% suggestion on down payment. What if you get 25% down payment? You want to figure all these out. So this is the model that you want to use. 95% of the deals that remember, this is a forecasting tool. Okay. If you use this as a forecasting and the model works under the forecasting, your deals will be 95% of the time, you will not have any issue with that, because there's different factors that go into this. Like we write a really good deal and we go look at the note and we like the note and the buyer is strong. This might get changed to 91%, 92%. This might be able to change it to 75, but we don't know that because we don't know anything about the property. We don't know what it looks like. We don't know what the true value is. We don't know what the sell price is. We don't know who the borrower is. We don't know a lot of things. That's why it's a forecasting tool. Okay. So all those things come into place. Now, this number, I'm going to say that since I'm showing this, it's really, really important. There's a difference between sales price and market value. Okay. Okay. And what I mean by that is, we get asked this all the time. People have been taught, well, you can sell owner financing at a premium. Okay. For example, a $200,000 house, some people might try to sell it at 210. or 215. Fine. Nothing wrong with that. We do it all the time. However, the note value or the value that a note buyer is going to look at is their investment relative to the actual value. Okay. That's why it's important to either have a BPO or an appraisal so that we know that there's nothing wrong with selling it for 210 if it's 200, but this number right here is going to be based off the $200,000 number. So you have to be able to adjust that. If you go too far one way or the other, it's going to screw up the ratios and you're going to have to give a bigger discount.
So Nick, Gerard, I think it's Gerard, he said rates just raised 75 basis points. Yes, but guess what? Just exactly what you just said 30 minutes ago with your ratios. The best part about what we do is the investors, us, direct to seller, wholesalers, direct to seller, whoever's direct to seller, they're getting better deals now because homes are sitting on the market. So the math is still works tremendously. You just proved it because you bought a house for 165 that a few months ago would have been 200.
So I'm going to pull up the example here. So I'm going to show you two examples here. So here's a positive. This is in your download. Okay. There's a positive cash example and a negative cash example. Let me make a copy of this real quick so I don't screw it up, and I'll go back and delete it. Duplicate, and I'm going to duplicate the negative, and then I'll go back and delete it.
This is the live version.
This is live right here. So I want to make sure I don't do
whoever is downloading is going to see.
Copy, yeah, but I'm going to delete the copies here in a second. So I just want to show you when I play with these numbers here. So here's a copy of the positive. Okay. So as you notice here, it defaults at 72 and 88. It's got a positive cash of 2158. Bought it for 110, sold it at 180. So if you take, I don't know what the number is, let's just see what happens. If I take 110 and I divide it by the sales price that I'm doing, it comes out to be 61%. Okay. Now, the reason why that's lower, it's because of the fact that you have a second lien in here. So don't worry about that from that perspective, but this is a forecast. What I want you to understand is that there's a lot of things that we don't know really the answer is. For example, sales commission right here. I'm going to highlight some of these orange. I'm going to highlight what color haven't I used yet? Let's go with this blue right here. 7,200. Okay. Well, it may not cost you $7,200 to sell it. It's just a default number at 4%. We want to forecast for a worst case scenario, but let's just say for sake of argument, you're able to sell that on your own.
Hey Nick, the one that you bought for 165 got hard money, sold it for 222 and got what did you pay the sales agent for that?
I paid him $5,000.
$5,000. Okay.
Yeah. But the model would have told me 72 because the model is a forecast. But then when you get to the actual number,
that's less than 2.5%. So because you have a system in place, and those people, that sales agent will bring you deal after deal after deal after $5,000.
Does it cost? How much difference does it take? How much more time does it take to sell a $300,000 house versus a $200,000 house? It's the same.
Yeah.
Right now, $1 million house might be different. The point is the same. And since it's owner financing, it's even easier. So
and that's why the sales agents that you've trained, they're just flat fee numbers. And
hey, then don't sell my property. I'll sell somebody else sell it. I don't have to worry. Right. But I'm just doesn't matter, right? So you could sell.
But you would have paid 8,000 and it still fit the model.
I modeled it out so that I knew that it was going to work, right? And then I get that. So same thing with hard money costs over here. Well, maybe you don't want to pay 12.9 and 2. Maybe you can go borrow 8% money. Put it in here. I don't care. I wouldn't change the forecast. I would change the actual and see. So, but you know what? Look, you change this to minus 5,000. Now it goes up to 43.58. Okay. Well, what if you had to buy it for 120? You buy it for 120. Now what happens? Well, now you're $6,100 in the hole. So what has to change? Well, maybe can you sell it for more money? Probably not. So this is how this, and it's all deeply explained in the video. So, but look, if we have a true, this is based at 72% and 88 because at the time that we model it, we don't know the actual value of the property. We think we know what it is, but until we go do a BPO or appraisal, we don't really know, right? Because if we're off $10,000, the reason why we have this at 72, it gives us a little bit of margin of error. Okay. This technically can probably be 75%. And we would still get the same, we'd still give up the same discount. Okay. I put it at 72. I mean, if it goes to 75, this number goes down, right? Now, if I go to 72, this number is going to go up. I'm going to go back to what it was. What was this? This was 110. Okay.
Yeah.
You follow where I'm going with this, Eric? So this is a model that you can manipulate, but be really, really careful to manipulate it until you have actual data. Okay. Because if you leave it where it is and you forecast it the way it is, you can't lose. Where people make the mistake is when they go to acquire and they go to buy, they go, well, I could sell that on my own. So I'm just going to put 0 in there. Okay. And then they find out so then it's a good deal, but it ends up costing them $10,000 to sell it. And now it goes from a positive to a negative number. Follow me?
Yeah.
Well, you want to model it this way. If you can, there's a lot of ways that you can beat the forecast, right? One is selling it yourself. Two is getting
Hey,
cheaper.
Nick, real quick
Yeah.
with Eric, he has flips out there that may or may not be sitting on the market. So why not market as seller financing both? And then, let's say instead of taking a discount and making 10 grand, you take no discount and make 10 grand and have a second lien that pays you over time that's worth double or
Well,
triple.
let's just do it. Do you know? Let's
Yes.
just go through it real quick.
That's what we talk about. Like, so then
let's
you're
just
like,
show it real quick. It won't take,
I'll
literally
take
it'll
10
take me
grand.
2 minutes.
Yeah.
2 minutes to put this in. Let's see if one of Eric's deals would act or what the outcome would be based on what we know.
Yeah.
All right.
Yes.
So I'm going to go to this test because I don't think we put anything in it yet. This is how fast it is to go. What was your acquisition price, Eric? Give me an
Here,
idea.
let me open. I've got several
Just
deals.
pick
so let
one
me
and we'll
just
go through
open
it.
one.
While he's doing it, I want to go back and I want to show the negative cash model. So on the positive cash model, this is what we have done to cash now, cash flow, cash later. People go, well, I can't make this be cash positive. I go, well, then you got to negotiate a better deal. They're out there, guys. Don't just because somebody wants $150,000 for the house doesn't mean you got to pay him $150,000 for the house. All right.
Let me give you a great example. One of my wholesalers in Phoenix, I called him yesterday, or he called me, he sent one out, and I said, yeah, I want it. If they back out, well, keep in mind, I already knew who the original seller was, and I knew they're trying to wholesale this thing, was 75,000 down and on a sub 2. And I was like, hey, if somebody backs out, just let me know. I'll be here. Sure enough, he already called me this morning.
Oh, did he call you already?
Yeah, sorry, it was 4 o'clock when I told him this, and he already called me this morning at like 7.
And you know why that happened? I know exactly why it happened. Because guess what's changed?
Yeah.
The traditional exit.
Yes.
Guess what? We already talked about this with Eric. Eric, how hard is it to do a fix and flip right now when rates have gone up? Because you got to think about it this way. It doesn't only affect the investor that has to pay more money for their capital now, but it also affects the retail buyer. Look, you guys, the difference, let me pull this up. I want to show this something real quick. This is really important. Let me see if I can pull. I don't want to lose that screen. Let me do this. Let me show you this. Let's just look at the difference. Okay. Let's use a $300,000 house. A year ago, let's say rates used to be 3.5%. Okay. The affordability index, if you look at the affordability, that was a $1,347 payment. Okay. Rates are now what do they go up 50 basis points? What's it? 7.25 now, 7.5?
Just be conservative at 7.
Oh, let's do 7. Okay, so now the payment goes from $1,347 to $1,995. It went up $600 for the same property, same price, same everything.
That's at 300,000. You get to 5 to 800 and it's a disaster over there, you know?
You see, so what happens is that maybe Eric's got all the cash in the world and he doesn't, and he owns his own construction company and controls everything on the front side. And he's the best negotiator, direct to seller. Okay. But he still has a huge problem when he goes to exit. Because guess what? He isn't the bank. He's got to rely on Wells Fargo, Chase, Bank of America to qualify this guy, if they'll even qualify now at 7.5%. Not only do they have to qualify at the higher rate, they got to want to be able to buy it at the higher rate.
Yeah, the buyers disappeared. They're gone.
Hey, go see them. Go do a Google search right now and tell me how much the decline is. Somebody go on there right now. Go on Google and tell me. Somebody chime in and tell me what the decrease in mortgage loan applications has been
Oh my God.
over time.
It's
Month over
ridiculous.
month. Just curious. Okay. Because think about it for a second. Let's just say it's down 20%. Well, guess what? Now you have 20% less buyers. It's just a number. But guess what hasn't declined? Owner finance buyers. Because when we were doing these, when Bank of America was charging 3% mortgage rates, and we were still
Says
charging
25-year low.
how much?
It's a 25-year low.
25-year loan. Well, that's a great side of the equation to be on. Wouldn't you agree, Eric? How would you like to be the one that's now trying to sell something in a 25-year low? It's not good.
29%, down 29% from last year.
29%.
One says 29. Yep.
Yeah.
Yeah, and
Pick
if
a
you
number.
know how to do, if you know how to buy on terms and sell on terms, it's such a huge
Guys,
advantage.
but my
Perfect.
point is, so here's the difference.
Well, it goes back to the guy just said, $5,000 down, 2.5%. I'll sell with 30,000 down at 10%.
Yeah, let me tell you something. Rates, people think these are high rates. These rates are not high. In fact, I would say I would love home mortgages to be stable at 7%. That's a good deal. 7% money for 30 years is a good deal. But everybody's bitching and complaining because, oh my God, the rates are so high. Go do a search on the history of mortgage rates and tell me whenever they were below 7% prior to the last 5 years.
Hey, let's go over a deal that Eric has right now.
All right.
I think the group would enjoy that.
All right. So anyway, this is really important to understand the affordability though. Okay.
Oh, I know.
How it changes. Okay. All right. Let me go back to this. Let's see which one we're at. Got to find the right model. Hang on. Let me
You're
find
on
it.
the test.
It wasn't that one. Let's see. No, I think I changed it. Was it this one? All right. Let me share the screen. No, let's see. Let's see here.
16 to 17% in 1982.
16 to 17%.
In
Yeah.
82. But houses weren't
According
valued.
to Freddie Mac.
It's an affordability factor for sure.
All right, so let's go back to Eric's deal here, okay? Share my screen. All right, so Eric, let's just go in. I got the test right here. And follow on, we'll call it 1, 2, 3 main. All right, so somebody put a clock on me and let's see how fast we can get to this answer. All right?
All right.
Somebody say go. Eric, what's the address?
2886 West Bryant Place.
2886 West Bryant. I don't want a city and state. We'll just leave it right there. Bryant. Okay, that's close enough. Just filling it in. What was your acquisition price?
356.
356. Great. Did you put any rehab in it?
Yes, I'm almost done. I'm gonna land 31,000 plus or minus.
31,000 in rehab. Great. Okay. What do you think the sales price is on that?
When I
market
bought it,
value.
I was projecting 460 when I bought it, but things have softened. Now I'm thinking 445.
Well,
to
it
a
may have
retail
softened
buyer.
to a retail buyer, but maybe not for owner finance buyer. So right now, before I go any further, this is the first flag. Okay. I'm not saying red flag. It's just a flag. It says if you're going to buy it for this and put this much rehab in it based on the cost of capital, your minimum owner finance value needs to be 552. Okay. Doesn't mean you're going to lose money. Doesn't mean it's not a deal. It's just that's the first obstacle. So if this was better than that, then we would deal. So let's continue on. Do you, did you run a ZHVI on this by chance?
I don't know what a ZHCI is.
So what's the zip code? I'll have somebody else run it real quick. What's the zip code on this?
80120.
80120. Can somebody go into Google and do a ZHVI on 80120?
657, 591, 657K.
657. Okay. So what that says,
Mhm.
what the ZHVI, for people that don't know, it's a Zillow Home Value Index. What it takes is it looks at the median home price in that specific zip code. So why is that important? Well, the reason why it's important to me is because I want to be on the left side of the bell curve, not the right side, if I can, because there's more people that want to buy on the lower end of a price point, not the higher. Okay. Doesn't mean you can't sell it at the other end. Just more people have more opportunities means I can probably close it faster. So we're in a good position here, Eric, because you only are at 460. That's $200,000 lower than the median home price. Let me ask you a question. The houses that are selling for $650,000 and $700,000 in this zip code, is that the same school district as the one that you're selling at 460?
Yeah.
It
Mine's a
is.
townhouse. So that's why I'm on
Okay.
the lower side of that.
Okay, but it's the same school district. Do they discriminate for the district if you live in a mobile home, a townhouse, or a mansion in the public
No.
school system? Not that I'm aware of. They may start soon. I don't know, but that's why we do it. Okay, so no, that's number one. So what did you say the rental value was on this about?
This one's about 2,100 a month, somewhere in
Okay,
that range.
pretty low. Okay.
Yeah.
I'm already seeing things I don't like relative, if you would have been able to do this model, not to say you wouldn't have done this deal, but you probably wouldn't have done this deal as an owner finance exit, okay? But let's just go through the equation here. Did you borrow money on this?
I did.
And what was your rate? What was your rate and your points on it?
0 points, 10% interest. See if I can find the loan amount here.
And just give me an idea
300.
when you,
300,000 even. And
okay. Well, we'll figure that up here. So what was your acquisition date on this? Do you know? Ballpark.
it was 920 exactly.
920, okay.
Yep.
And so we usually default on a fix and flip at 90 days. Okay. Great.
Yeah.
So now let's just go right to the main numbers here. These are the main ones right here. Okay. So in this model right now, the sell this on terms, you would have to write a check at the selling of the first lien for $131,000. This has a negative $2,400 profit per day, which is not good. Okay. And I'm sorry, the net cash value is minus 2,400 because you're giving everything away, even on the discount of the note. You're losing $26 per day. So we would not seller finance this deal at this price. So let's just say, sake of argument, that we were able to push this out a little bit.
What's
Let's say we
the
could-
down payment? What down payment?
Oh, I
did you
didn't put
get?
that in there. You're right. That's why it was so far on. So
I was
I'm
like,
gonna put
wow.
down payment at 50,000. Still gonna be not great, but so I'm gonna change this to 75 because maybe we got a VPO and we can support that. And I'm gonna increase the note value to the best case scenario, just the best case if we could do it. I want to say 92%. I just want to see what best case is. We already know worst case is not good. So even with the best solution that you could hope for in this model, you would have to write a check for $55,000 and your net cash value is 9720 between the second note and your profit per day. So what does all that mean? Well, it means that you're going to have to write a check for $55,000 to get a $65,000 second lien that pays you $558 a month. Well, I don't know what that comes out to be. I think, it should be right
Hey,
here.
but Nick, if this is a fully renovated house, is it possible to get 15 to 20% down? And the answer is yes.
Possibly we'll look at that here in a second. So
Okay.
what this says right here.
'Cause
what
he
this
already
says-
owns it now. So now we're going to work on back into
So what this says though, this is what you do, and you got to scratch a check for $55,000. It doesn't mean you lose $55,000. Okay. It
Right.
means you're investing $55,000 into some form of return. Well, the return is a $65,000 second. Follow me?
Mhm.
I have never had a deal this side of the equation. But let's just say that's the best you could do. Okay? Let's just
Hey,
say
you're
that's
still 6 minutes in, you're 6 minutes into the annals.
well, because it's such a hard deal to do. But my point, and I'm explaining this, but right here, even if that's the case, your return on your investment is still 12%.
Yes,
Right.
Okay,
still not horrible.
it's
Yeah.
not. Yeah, I mean, I think it's. Let me see.
So go up and do 15% down because it's rehabbed
Okay,
on what, 460?
let's put it 75,000.
Yeah.
Okay, now you're coming out of pocket $30,000. Is it possible to get $100,000 down payment? Yeah,
Mhm.
it is. I wouldn't model it that way, but you can find there's a lot of people out there that are cash.
What's his second lien go to then at that point?
Goes
40.
down to 40.
Goes to 40 and 344. So now you're 344 times 12. And it tells you
Yeah.
you just went up to almost 13.6%. So I mean, it's still not.
Yeah,
not
but see,
great.
the point is that, so let's talk about this for them. It's really important. If Eric had used the model to begin with as a tool to see if this was a deal or not a deal relative to buying this property, and this was one of the exits he was looking at, he would never have bought this deal. He wouldn't have done it. Why
Right.
would he? Because no one's
Well,
gonna.
I could
Hey, if you
flip
guys
it.
want to invest, $30,000 for a $40,000 second lien and get a 13% return, I'll give you all of them that you want. You don't have to go do this. Just tell me that's what you want. Just give me as much money as you have. I will give you the 13%. I will give you the second lien, and I'll do all of them that you could ever.
But this deal here is clearly a flip that you could reinvest that cash flow into other seller finance opportunities, right?
Yeah, I think I could walk away even with the reduced value with around 23K.
Yeah.
On a fix and
Profit.
flip.
Yeah.
Yeah, which isn't great, but
You wouldn't do that again. You wouldn't put all that energy and effort and risk to make 20 grand. Typically speaking.
yeah, probably not. Only if
But
I
we-
really
you
need
bought-
it.
but-
Hey, real quick, someone mentioned up in the deal, grandma's house. Grandma's house is a house that hasn't been renovated. It has all the old everything, but it's livable. It's not, down to the studs. You could move into it and renovate it over time, like a lot of our seller finance buyers do. They'll go and actually put their sweat equity into it. So the question is, if you did no rehab and you sold this on terms, then what does that look like? That's a good one to take the rehab.
So let me
out.
ask a question. Let me see if I can find. I don't know that we had it up here or not. Let me just see something real quick.
But those are some of the questions. That's why we do this. You asked all these questions like, well, shoot, if I just didn't do any rehab and sold it on terms, was this a grandma's house? Was it habitable? And someone could have lived in it the way it is, rather than you update it with the 31,000. Which obviously it's a townhouse. We would stay away from townhouses too, but that's another thing.
It was questionable. It probably could have been. I probably could have put 5 into it, and it would have been.
But
right.
our seller finance buyers that we focus on want single family homes. It might be a 3-1 or a 2-1 that they turn the garage into a carport into a bedroom and a bath, and it goes to a 3-2 and a 4-2, and now they just added value to your house that you didn't do anything with, and then that's where the math really works. I mean, we have people in other markets like I said, buying at 50%, buying for 75, selling for 150, getting 30,000 down. And their cash flow, and they're not doing anything to these properties. It's crazy.
Yeah, so I was going to try to pull up a
Yeah.
few here. Let me see. I'm just going back here. Let me see if I have any I can share with you real quick on the site. Let's see here. What's this one look like? So let's see. What's this one? River Oak.
Dan also said, take out the commission. Absolutely. I mean, you could take all that out. We're just doing the projection based off of the math that you want to have in there. So you don't, this is an after the fact projection, right?
Yeah, I just want to, since we brought up grandma's house, let me try to find something here. Let's see, some of the, I think somebody just put a bunch of them up here.
That, and then Mark added in there, you could you have worked with the seller and leverage his current mortgage in order to do the deal? Absolutely. I mean, right now, that's like one of the best strategies ever. Rather than go pay hard money, you're just using the seller's debt in order to, if you know you're going to exit out. And that's what's so great about, getting to use some of this debt. And then what happens is if you get a good buyer and that's good, why not add some cash flow to the seller and keep the thing in place? That's what we'll be talking. I mean, there's risk involved, that's why you got to analyze your risk tolerance in regards to taking over people's payments, because there is
So
risk.
let's see here. So this is a perfect example here. Let me share my screen. This is one we just got here. Let me share this if I can. Okay, so let's look at these pictures right here. Okay. And I know what Eric's answer probably is on this. So let's just start. So here's the front of the house right here. Okay. Yeah, I
Ooh.
mean, anybody that's gonna fix and flip it is gonna paint it. They're gonna do all that work. The roof looks good, great. Let's go see what the inside. Okay, you got pergo. What is this called? It's not even pergo. It's the
Is that carpet? That's
no,
carpet.
it's like
The
those.
70s.
Oh, parquet. It's the parquet floor.
Is that oh, okay.
Parquet floor. Hey,
Okay.
Eric, how many times do you put picture frames on your walls these days?
Well, when I have it staged, I'll put artwork.
No, but I mean,
on
see
the
that?
walls.
Can you see the
On
little
cabinets, never
picture
never
frame
happened.
in the right here on the counter? A little picture frame, little quarter round molding. See how they did
Yeah, I
that?
don't do that.
You don't do that anymore?
No,
Do you still
no,
use this 12-inch? This
No.
12-inch kiln beige tile? You still use that?
especially not ones that have been broke and patched back in after the fact. Like
Right, okay.
it's there.
So you don't make the houses look like this. Okay, let's continue on.
Nothing like that. Nope.
Okay. Okay.
This
Oh,
is
ceiling fans it up, right?
this is the definition of a grandma house. Would you agree?
Looks
Perfectly
like it to
clean.
me.
There's nothing wrong with this house, but Eric, when he bought, if he was to buy this house, like most people that would buy that, you're going, well, I gotta gut this thing. Right? It's a full
Yeah.
gut job. The only thing
Yep.
that this house has going for it is that it has no popcorn on the ceiling. At least I can't tell. That's good. And you have actually a couple already semi upgraded fixtures, ceiling fan, light kit. Okay, let's go on. Let's see what else we can not have to do in this house. Well, I think it's got granite on it. Let's see, is that granite? Yeah, so that's granite, I'm pretty sure. Let's see if I can zoom in a little bit here.
Looks like granite.
Yeah. Maybe it's got a corner, it's got a, I don't even know what that. I don't know what that is. It's not bullnose. I don't know what the hell that is on there. I think it's granite.
That's for
Do
Mike.
you always put white appliances in your houses these days when you do the construction?
Never.
Do they even make white appliances anymore? I don't even know they do.
They do.
They do? Okay.
Yep.
Kitchen cabinets, but guys, the money that you save in the rehab, you can pass it on to the buyer. They're
And
perfectly,
it's time. Like,
yeah. How many of these
the
can I
minute you had
do?
the minute you had this thing locked up, it was already sent out and sold to a seller finance buyer.
Just let me ask you a question. This is a really good question. And I'm glad we're just going through this. If this house showed up on let's think about traditional sales. What do most sellers do when they go to sell? They put it on MLS. Would we agree?
Yep.
Or of them put it on MLS, then they sell it themselves or go to a wholesaler, right? The reason why wholesalers win is because they get to the deal before the realtor does and makes a better offer to the seller. So let's just say this listing showed up on MLS. Okay. A traditional retail buyer that could qualify, that would want to buy, are they buying this house the way it looks right now
For a low enough price. Yeah.
for a low enough price? That's the first obstacle. What's the next obstacle? What if they're an FHA buyer? Do you
It's
think
FHA loanable, I think. Yeah.
it's hard to say. We don't know for sure because we haven't seen the foundation. We haven't seen some of the windows yet, right? I mean, we could probably get it, but maybe it is and maybe it isn't. Does FHA still require window screens? Anyone know?
I haven't had that come up ever.
FHA used to require to have screens had to be on windows. You know, I mean, there again, look at that ugly brown paint on the walls, man. Just like
This is a great house.
this is a great house, is right. We already got rid of it. I mean, why wouldn't we, right? Because we made it. Oh, can you even get these curly Q light bulbs anymore? These old, these danger light bulbs? I don't think so. Okay. But guys, this is, if this came across your desk, Eric, you're in Denver and this house is in Florida, and you knew how to find the buyer for this, would you have a problem doing something with this house? Why would you? You know what?
Probably not.
Well, hopefully you're not. And if you don't, send it to me. I'll do it. I'll pay you for it and give you a couple grand to do it. This one past FHA, there's no pan down here. So that would probably be a fail. So I mean, and that water heater looks pretty old. So they probably wouldn't pass an inspection either. So guess what that means? Money, right? Time. So if the seller has this and you want to sell it to a retail buyer and you put it on MLS, guess what's going to happen when they do the home inspection? It's going to get flagged. What's going to happen? Seller concessions, time, money. Okay. It doesn't happen in the seller financing space because we don't have to get an inspection done. That's the buyer's prerogative to get it done. We're the lender. We don't have to have any criteria to do this. If they don't want it, just because FHA requires it to be, it has to be safety. It doesn't mean that there could be cracks on the floor, tiles, whatever. Guys, so these are everywhere, man. I love these houses. They're everywhere. There's a big crack right there. Oops. There's a big crack right here. See it? Probably a foundation. That is not a settlement crack, I don't think. Probably not. It's pretty big. Okay. Maybe there's a little bit of foundation issue. I don't know. But that's my point. No, there's even a close-up on it. Yeah, it's hard to tell what that is. Guys, so that's what you're looking at. I don't even think, can you match this color green anymore? Is it even available? I don't even know. Okay.
That's a great house.
Exactly. So there again, I just wanted to show that visually because it's just, we sometimes make this harder than we need it to be. And we want them to be nice enough, but not too nice, right? Too nice means you cost more money and they can't be non-livable, right? If it's already been gutted to the studs, it's not going to really work. But there's plenty of these deals out there. So I would say, guys, even if you're a fix and flipper or a buy and hold, you still need to run the model and see where it is, because it's a good barometer test and see where you ultimately need to be. And there's plenty of them to get in there. So what other questions do you have, Eric, on the model? I mean, on either how to use it. I know you're not happy with the outcome of it, but that's okay. You might just have to go sell it retail and have to sit on an extra 30 days. Your best bet to getting break even now or close to it is just to sell it. Sell it to a cash buyer, sell it retail, because you already did the work. So it's going to pass an inspection. It's probably going to pass an appraisal too. So
yeah. With that house, I can exit out and be positive. And I was looking at it maybe being a good one to try this with, but probably not.
I would say probably not.
But Nick, you could still list it accordingly. You just want to make sure you get the down payment that makes sense. It's tight. It's tight. But
you might have to. But you know what? Somebody might come in and say, "I got $200,000 to put down." Then the deal might work. But you need to know what that answer is. You can say there's nothing wrong with putting it on the listing and say seller financing available with 30% down payment.
Yeah.
If that's the number,
try it.
If that's the number that you need it to work, you know what it's like? It's like taking Visa and MasterCard, but then, let's add PayPal. Let's add Bitcoin. Let's add Venmo, whatever. All you're doing is adding another type of payment method to your exit, because you only need one person to say yes and walk in that's got $200,000 down. And I'm telling you right now, there's buyers out there that have $200,000 and they can't go get a bank loan. So and even if they had $200,000 down, they can't go get a Wells Fargo bank loan.
Right.
Okay, they could have 10 times the amount of cash in the bank to buy the house and not qualify, because that's not how banks underwrite deals. But you could, and you could write it and see it. It could be a lot of things. So, don't assume. I guess the point I'm making is, don't assume that just because you wouldn't do it or can't do it, that somebody else won't. Okay, the big thing I want people to understand: just because you wouldn't put $100,000 down on that townhome that's worth 450 doesn't mean somebody else wouldn't or couldn't or won't. Okay, you'll learn. I learned that a long time ago. I go, how the hell? They wanna
The
put-
cool thing, but Eric, here's another cool thing. You already own the asset. So if you start marketing for seller financing, and God forbid you get 7 or 8 people that don't quite have the down payment, but they need a house, that's what you do. You just go find them one. So now you got
Right.
8 people. Now you got 8 deals now just off one house that you're not even going to probably use
Let
on
me show you
seller
one.
financing.
Here's
But
another.
you're going to market it that way. Actually, Spencer in the group asked, does the Creative Deal Maker program work for sub 2 deals? 100% it does, but we go into more detail in our paid group because there's risk involved, and we don't have the time to go into the details, but it 100% works. It's an arbitrage play. I mean, it's fantastic.
Well, let me show. I want to go back to this. Oh, where did the other model go? I think I closed it. Shoot. Because here's the other thing. You know what? Let's do it on here. Let me pull up the calculator again. Because here's another thing that you can think about too when you go do and it may not work on it, so we're just going to play with it and see. Let's go. Let me share my screen. So let's go back to the note calculator for a second. You're paying interest only, right?
Yep.
On that note. And what's
Yeah.
the term on it? What's the term on it?
Unlimited. It's private money.
Private.
And
Okay, so long
Yeah.
as you're paying. So let's
Yeah.
just say, so what is your monthly payment on that? What's just your interest only payment?
let me get it open.
So 450. Let's say you get sell for 420.
Well, it's $300,000 on that one
Just tell me the
at 10%. So times
30
0.1 divided by 12.
30,000 a year.
I want
Well, it's 30,000 a year if it's 300,000 at 10%. Right?
Yep.
So 30,000, let's see what that can divided by 12 is 2,500 a month. Okay. So let's just say that you sell it for 470 and you get 40 and you get 50 down. Okay. You
Mhm.
see my screen? Is it on? Okay.
Mhm.
Yep.
Look, what's stopping you from just treating this as a wrap mortgage for a year, 2 years, 3 years? Because let me show you why this is the other way that you can save this deal and why it may work. So if your payment is 2,500 a month and you're collecting 3,500 a month, you're making $1,000 a month cash flow, right?
Yeah.
Right.
On the cash flow side of it. However, you're not making a principal pay down. Okay, but let's just follow me for a second. You owe $300,000, right?
Yep.
And how much do you have of your own money into the deal?
Let's see, my basis is
350.
381. So I've got about right now 82. By the time it's done, I'll be somewhere around 85-ish.
Okay, so you're all in it for 385. So let's just go out 5 years. I'm not saying I would recommend this. I'm not saying you should do it, but let's just go out 5 years. This is our amortization on what we would if we sold it to our buyer for 420. Okay,
And kept the existing hard money in place for that 5 years. or
wrap the
3
hard
years.
money and you just leave it there,
Right.
private money.
Yeah.
Let's go out 5 years. Okay, 5 years. Your buyer still owes you $404,000. You see that?
Yeah.
Okay. Now, if you just collected 60 months and you made $1,000 net on that, right?
60 grand.
Made 60 grand, plus you made the 50 grand on the down payment, right?
Yeah.
See where I'm going with this?
Yeah. Plus 100 on when I clear it out. Yeah. It turns into a beautiful deal.
It turns
So John said you can't wrap for less than 8 years. You're not wrapping. the term to the buyer is still 30 years, but what you're doing is pushing it out 5 and then selling off the first and keeping the second. That's what you're doing.
Or selling
you
the
got
whole
all
thing
the
or
money.
whatever it is.
Which you got
Because
all the
you have
money in the world to do
amortization
that.
on, you have amortization on your side, right? This is all
Yeah.
amortized. So this started at 420. He still owes you 404 and you still collected 6,000 in it. I mean, you netted, but in reality, you made 3531, right? You made 3531 times 60. You brought in $211,000 of principal and interest, but they still owe you 404, right?
Right. So I would wrap the existing private mortgage.
Yeah.
And so it would
Surely
stay as
could.
the lien on the property. And then my wrap would be like a second position to the owner who I
That's right.
financed. And then
And
it also
it's
take
up
a
to,
second.
and it's up to your I do this all the time with my private lenders. I'm like, hey, you want to just stay in the deal? They're like, yeah, I'll go another year or 2 or 3. You're like, fine, but you already know you already know you could sell the first lien at a certain dollar amount. You know what I mean?
Right.
So where would that first lien have to be at 75%, right? What was it? 460 times 0.75. That's 345, right?
No, it's
Even
47. No, it's 475.
Was the sell price?
It's 470 minus 50. So 470 is the sell price. So you need to be
Times
470.
times 0.75 minus even 10%, you're at 317, and you only owed what?
He's at
300.
320. His first lien note value is 324.
Well, yeah, but still, I mean, you made 60 grand plus a down payment
Exactly.
just by leaving it where it's at and wrapping it.
Now
Yeah,
there's risk in there, right? There's risk, right? That's why, you got to take that in consideration. There's risk that the buyer doesn't perform.
but I mean, that's a great, that $1,000 a month
Hey,
on
what I'm
these
saying
cash
is,
flows.
as bad as this deal looked on the surface,
Yeah.
it doesn't have to, it's only a loss if you sell it, right? I mean, that's the
Yep.
bottom line if you sell it for a loss. So
But shoot, it cost you 10 grand, you make 40,000 cash and 1,000 a month. I mean, how many of those deals would you do?
well, shit, do you think I can
Tons.
promise you this turns into a pretty damn good deal? If you
Yeah.
if you can keep that private money deployed for 10 years,
Yeah.
because in 10 years,
Or you go to your private lender and go, hey, I'm paying it off, or you want to drop it to 8% and you don't have to do anything and your money gets paid. You can always renegotiate anything. You
look at
know?
120 months, it's still 378.
Yeah.
Okay. You know what I'm saying? Guys, so
Yeah.
that's why that's why this stuff's so important, and understanding amortization. The two biggest things that I always recommend is run the model to forecast, but understand how amortization works, because banks learned how to do that a long time ago. And when you can learn how to amortization and how to use it like a bank, you'll crush anybody. I always
But
joke about this. What's
Eric, the best part about where you're at right now, I mean, even though it's a little stressful because you have, you got some assets out there, if you start marketing for seller financing, you're going to open up a market that you didn't know existed. You're like, holy crap, there's a lot of people out there that have 20 to 120,000 down, and you're like, then you just back into what, if it makes sense to you. You don't have to accept it,
Yeah. No, I love it. I can market all the properties I have before I hit the MLS and use it to bring in a buyer's list of owner finance people.
You can do that. In fact, in Texas, you can't market you can't put seller financing in the marketing, but in Colorado, I'm pretty sure you can.
Yeah, I think you can.
Yeah.
Depends. You
Yeah.
can't put it in. Well, it depends. But here's the thing. I joke about this all the time. Is that the reason why? And it's not really true, but it's true enough as far as making my argument. Is that the reason why most people are landlords is because they haven't figured out how to be a lien lord yet.
Yeah, that's right.
Because once you understand how to be the bank and get paid amortization, why would you ever want to be I know why you'd want to be a landlord. Okay. But banks aren't landlords, not intentionally. So it's just another strategy. If you're 25 years old, go be a landlord, knock yourself out. If you want to go through the fix and flip and watch all the shows on TV, then be a fix and flipper. Nothing wrong with any of those.
It's amazing how many 25-year-old wholesalers are out there that are reaching out to Eric, right? To me,
Yeah.
like going, hey man, that's the deal. I literally just the one I was telling you about with 5,000 down and 300. He just texted me
I
like,
got
hey,
some
I
really
got
good stuff I want to share inside the private group. I can't say it now because this is all over the map, but All right, so let's just wrap this up. Eric, hope that helps you
I
out.
have one really fast
Yeah, go ahead.
question.
Yeah.
I think it's an easy one. At what point do I bring you guys in? So it looks like there's a site where I can pay like $700 or $1,000 to have you look at the deal, and we.
Well, it's the
Is that after I
transaction
got a
management
buyer,
fee.
or-
So what happens is that, and then in the instructions, it's in the resources as well. And
Okay.
we can, it's called deal submission process, I think. It tells you exactly what, so you have to do 4 things, okay? You have to find the deal, which you've already done. You have to analyze the deal, which you sort of did.
Right.
You have to fund it, which you've done. And now the last thing you have to do is find the buyer, right? Once the
Okay.
buyer is found and it meets those criteria, then that package gets submitted to the transaction management team, and they will help build out all the collateral files and stack get the borrower through underwriting and get it closed to title and create the promissory notes, set up the servicing, everything that needs to be done so you can sell that note at some point.
But before you close the loan, that's where Nick and I would come in and say, okay, here's where your first needs to be. So here's where your second is. So you don't
We may be able to tweak it a little bit once you get
Yeah.
in there and say,
Right.
hey, we're gonna write a 75% first, 12% second, and get 13% down or something like that, right?
Yeah.
We can look at that as well. And then once it's set, then it just then it gets all processed, and then it kicks out the note on the back end. You know, are we going to leave that hard money loan in place in this example? Is it going to get paid off at closing? Those are all things
Right.
that get done through the transaction coordinating side of it. And then from there, but you don't have to manage or screw around with underwriting the buyer, right? We'll tell you it'll all get done for you, you know, and we'll set all that up, and the buyer will go fill out
Right.
their stuff. And
Hey,
then we'll
Nick,
use
is
our title
August
companies.
REI, is August REI in Colorado? I forgot.
Not right now.
August.
No,
No,
but-
there's Tiago here though. I know. I
I
heard
think
you
it's a
talk
different
about
one.
Tiago.
I think it's a different one, but that's okay. There's other ones that we can use on there that are vetted that the work, but that's fine. So yeah, the short answer is knew that, we build it out, and you know, we can tell you the note value based on how it's created and tell you what we would pay. And if you want to turn around and sell it to us, cool. You want to turn around and go put it on LinkedIn or Facebook or any place else and sell it, that's fine too. It doesn't change
Right.
how we do it and what we're structuring. But I will tell you this, the note values in general that we're able to obtain is substantially higher than the market average. And the reason that isn't because we're special and we know more than anybody else. Well, actually it is, but it's not for the reasons that you think. It's because we structure the deal and stack everything to demand and command premium pricing. That's really the answer. We cross all the T's and dot all the I's, and we don't end up with a bunch of scratch and dent paper at the end of the day. Okay?
Scratch and dent paper is work. And so people
Well,
are
and that's why there's a
our-
discount.
our fund and who we work with there it is.
95% of the paper that's written out there is written incorrectly. Okay. And I don't mean it in a legal perspective. I'm just talking about we talk about risk, right? What is an investor note buyer buying? He's buying a return relative to risk. Well, for example, if you go and close this and you do seller financing and you write a 5% mortgage and the yield needs to be 10, guess what's going to happen? Huge discount.
Mhm.
Okay.
Well,
What if
no, but Nick, it's just like the deal I'm doing right now. It's a $295,000 2.5% loan. What's that note worth?
depends?
Whatever the value is and the yield that the note buyer wants,
All
right?
yield driven most of the time.
And risk and the value. So that's why
It all
getting
goes hand
sellers.
in hand, right? So,
Yeah,
that's
yes.
why, but is it serviced by a third party servicer? Because there's a cost associated with that. If you're self-servicing and now somebody else buys it, guess what happens? It affects their yield because now they got to put $35 a month of that $500 payment out of their cash flow in the servicing. What are the taxes and insurance escrow? Is it a mortgage deed of trust or is it a contract for deed? right? Did you take a 1003 application from the borrower? Did you disclose 32 times through the process disclosures to a buyer? All those things have a significant impact to a note buyer. Some of them are more important than the other. They're not all equally done. But I said it once, I'll say it before, and I'm going to wrap up. There's a reason why banks do what they do, right? There's a reason why they structure things right there. Well, there's a lot of compliance and there's a lot of issues and there's a lot of challenges and risk. So you have to make sure that it's done correctly, because at the end of the day, if you don't, you run the risk of getting taking a severe discount that doesn't need to be taken because you just didn't know how to structure it. That's pretty much in a nutshell. So,
Hey,
other
Nick,
questions?
I gotta hop off at the top of the hour, which is now. So but whoever, I hope you guys enjoyed the call today.
Yeah.
If you're not in the group, get in the group. It's going to be, I mean, the return on investment's crazy. Eric, I know you're in there. If there's anything we can do to help, please get in the new platform, submit your questions so we can get in and help you. If that's it right for now, but we do this every week. So whatever we can do to help you guys get more deals and take advantage of this opportunity where everyone thinks the world's ending, we're gonna have a nice run here, like for a while, which is cool.
I will literally probably personally do more deals in the next 12 months than I've probably done in the last 5 years combined.
Yeah.
With half the energy. Seriously, that's
Yeah.
the opportunity.
Yeah.
Gerald, Gerard says I need private money. No, you don't.
Yeah.
You don't need private money for anything.
I know. I need to go direct to seller. I know.
We'll cover that next week in the group coaching call. All right, guys, we're out of here. Have a good one. We'll see you soon.
Later, guys. Have
All
a
right,
good
take
week.
care.
See ya. Bye.